So let's go to Gareth Aird now, who's the head of Australian economics for the Commonwealth Bank. Good to talk to you, Gareth. The interest rate rise, how quickly will that flow through to mortgages? And what sort of pressure do you think that's going to create across your customer base?
G'day, Chris. Well, look, the interest rate rise by the Reserve Bank today is likely to flow through to higher standard variable rates pretty soon. It's up to each individual bank to work out when they want to pass that increase in costs on to those people who are on a floating rate mortgage. But the simple reality is that the whole point of the Reserve Bank raising the cash rate is for it to flow through to higher mortgage rates to cool the economy a little bit. Inflation's running red hot here in Australia. And so the Reserve Bank has done what they normally do when inflation's high, and that is raise interest rates. So I think it's not so much about did they go today or did they wait until June. I think what's more important from here is just how high they end up taking the cash rate, because that'll have an impact on those people with a mortgage. We've got the view at the Commonwealth Bank that they'll deliver a fair few rate hikes, but they won't ultimately end up taking the cash rate too high, simply because those rate hikes will be quite effective in cooling the economy in such a way that we still get good economic outcomes, but it just drops that rate of inflation.
Now, I don't want to underestimate the pressure that this will put on some household budgets, but really we're going from emergency lows and people should have factored these rises into their budgets. I'm a bit more worried about small business, given what they've been through, notwithstanding all the government support. What's going to happen with the financing arrangements for small businesses?
Well, generally, small businesses prefer to fix their loans, and changes in interest rates tend to have less of an impact on business as to what they do to households. But the way that higher interest rates end up affecting a business in the main is that it impacts consumers, and therefore it changes the decisions around what consumers spend their money on. So I think if the Reserve Bank was to end up taking the cash rate too high, what it would do is then put a bit of strain on those businesses that are selling discretionary goods and services, because ultimately they're the things that households will move away from spending money on in order to service that increase in the cost of debt. Now, I think it's interesting to keep in mind too that we talk about the Reserve Bank moving the cash rate away from an emergency setting, but going into COVID, the cash rate in Australia was just 0.75%. So we've been very used to very low interest rates here in Australia. Lots of households were under the impression that interest rates weren't going up until 2024 at the earliest, which is what the central bank was saying. And here we are today in May of 2022, and the Reserve Bank has delivered an increase in the cash rate. So, look, households in the main are going to be reasonably well positioned to absorb higher interest rates. But I think from a psychological perspective, these rate hikes have come a lot earlier than many people thought. And I think for people that have taken out a loan more recently, they're going to be going back and reassessing their finances and working out how it is that they then afford the increase in the interest cost and what it is that they're currently spending on money that they might have to tweak spending decisions around.
Big question, but if I could have a fairly concise answer, there's all this stimulus, unprecedented amounts of stimulus washing through our economy and the global economy. Now we've got to try and get on top of inflation without tipping the joint into recession. Is that a very delicate and difficult challenge? What chance a recession?
It is, and we refer to it as the Reserve Bank needs to thread the needle here. And in Australia's case, it's a tough one because we've got a very indebted household sector, so rate rises will be very powerful, and the distribution of that debt is not obviously spread evenly. You've got lots of people that borrowed lots of money well before rates went down, and they're very well positioned. Then you've had a lot of people in the last 18 months that have taken on pretty big mortgages at very low rates, and that's where the Reserve Bank's got to get this one right. They've got to raise rates at a pace, I think, which is shallow enough not to cause too much angst amongst those households that have borrowed more recently, still trying to maintain that strong economy while also, of course, taking a bit of heat out of inflation. So it's all finely tuned. We think they'll get it right, but I think they've got to go not too aggressively, or as we saw today in the consumer confidence data, there will be some anxiety out there in households, and that could negatively impact the economy.
Yeah, don't frighten the horses. Thanks for joining us, Gareth. I appreciate it.
Cheers, Chris.
Gareth Aird there from the Commonwealth Bank of Australia.